Good morning. Thank you for having me today. My name is Penny Madsen. I'm a Director of Research at CBRE looking at the data center space across Europe. Today, I'm going to be talking to you about European data centers and the supply shifts that we've seen as a result of COVID. So CBRE is a global real estate firm, but we also have a very large and holistic data center practice. We cover everything from the ground to the cloud. We can do site selection, we can teach you how data centers work and the market works, do consulting, operations, and help with transactions. So I just want to set the scene before we go right into the presentation. So this was released in March. This is a minute in the internet. So what do we see in a minute in the internet prior to COVID? 694,000 Instagram views and 1.1 million online spending. I mean, that's pretty phenomenal. After lockdown, this is what happened. Internet use skyrocketed, went up 70%, streaming up 12%. Zoom users, 10 million in December. I hardly use Zoom prior to COVID myself. 200 million in March. Cloud revenue grew by 20%, their Synergy research figures, and colo leasing and data center construction spend by cloud providers up 10%. So I'd just like you to keep this in mind as I go through today's presentation, giving you a European snapshot on where the industry was heading, looking at life for the industry after COVID, or what the impact of COVID has been. And I'm going to argue that there has been some impact. And mountains and molehills, what are our predictions, big and small, for the industry going forward? So our focus, well, my focus at CBRE, not the entire team's, my focus is really on the leased data center market, so the wholesale and retail co-location firms. And just to set the scene, typically when we talk about the leading markets across Europe, the markets that actually act for a bellwether today of where we see demand going across the rest of Europe in time. And we look at Frankfurt, London, Amsterdam, and Paris, markets we collectively refer to as FLAP. Each of these markets is actually quite distinct, even though they're the four biggest data center markets. Frankfurt, driven by the Mittelstand, the large middle market that's increasingly becoming international in nature, GDPR, attitudes to data privacy, and residency. London, the largest of these markets, we see high demand here driven by hyperscalers, much like we do in Frankfurt today as well. But typically it's been a market that has formed around the connectivity options in London, the number of corporate headquarters, access to eyeballs, but also the UK's business environment. So English speaking, access to common law, etc. Amsterdam, less local demand, much smaller country than Germany and UK, but it's a gateway market. It's being used typically to access the rest of Europe. And we've seen a lot of services, hosting, gaming companies, and also hyperscalers enter this market. And Paris, it's been a little bit slower. It's a smaller of the FLAP markets. We had a lot of enterprise demand to start with. We're only just starting to see the hyperscale cloud providers come into that market. What we see across all the four FLAP markets is this large amount of hyperscale activity. Hyperscalers will start to build out zones, and we see activity from second-tier cloud providers, enterprises that are moving to cloud, and just really, skyrocketing rates of adoption, rates of supply growth once we see the hyperscalers enter. So what are we seeing now? I mean, we already had some hyperscale interest in Dublin and Madrid, and relatively in comparison to the other second-tier markets, large data center markets in Dublin and Spain. But we start to see this progression east. So we've seen Stockholm, Zurich, Milan, Vienna, Warsaw, and even more markets become of interest as cloud providers look to roll out services. And we see digital transformation happening across the rest of Europe. So that just paints a picture of where the market kind of sits. I just wanted to show you, and this chart shows you our Q2 figures on market supply across those flat markets, and I've just picked out some of the second tier markets as well for you to look at for leased data center supply. Just so you know, the figures in bracket, the figures are total megawatt supply. Figures in brackets are actually that you see here are actually the amount of supply that can be added given existing supply, and then the pipeline is on the right. So you can see 276 megawatts is quite a bit. But I just want to look back at 2019, what we saw through 2019 as well. So all four markets, these flat markets, collectively grew by 24%, so almost a quarter again, which is huge. At the end of 2019, we predicted that we would actually see a further 461 megawatts come online by the end of 2021. And it's not just the number of data centers in these markets that we've seen growing, we've actually seen the size of each individual data center grow as well. As hyperscalers move in, just last quarter, we saw some deals signed close to 30 megawatts for hyperscalers taking whole sites on their own, which is quite a lot for many of these markets. 2019 was also a record year for take-up so far. Over 200 megawatts of capacity was signed across FLAP, and most of that was seen in Frankfurt, a market that was already, as a result, seeing some supply constraints. So what was driving all of this demand? So I mentioned hyperscalers, and that's all I've really mentioned so far, because they make up around about 80% of the demand seen across Europe today. But we're also seeing a growing mix of the second-tier cloud providers, so software as a service providers, for example, Oracle, Salesforce, growing both footprint and into new locations, but also the amount of supply they're taking. And then your managed service providers and others that are on selling cloud. We're also seeing the market driven by the idea of proximity and latency and edge. Edge is not quite there yet, but it is on the agenda for many organizations today. But there's also this growing need for companies to move from operating their monolithic data centers and serving a whole region through that to actually having more of an in-country presence, using co-location as well as an on-ramp to cloud. And there's also the argument for latency as being a way to enable better innovation and better agility across companies. Global connectivity has also been driving much demand. I did a study a couple of years ago where we looked at what key requirements for international companies coming into Europe were, and there's a lot of demand being driven by international organizations across Europe. And interestingly, one of their key requirements when they chose a provider was actually international connectivity. They were using Europe not only to serve local customers here, but they wanted to be able to serve a wider region. They want to serve maybe Africa or the Middle East, or tap into Asia and use Europe as a hub from which to have a global expansion. And security. So there's no doubt GDPR is something everybody has gotten quite familiar with these days, but it's been quite a driver for data center supply across Europe, particularly in markets like Frankfurt, where we have sort of residency fears, etc. And just, you know, even in the last few weeks, we've had discussions around privacy shield, data sharing, and data regulations come to the fore again. So it's not an issue that's going to go away anytime soon. And then earlier this year, we had this thing called COVID come into the market. And initially it looked like COVID was actually going to be not so bad. It was great for demand. We saw increased demand for hyperscale cloud and other services. We all moved online, started to use more services. Businesses started to think more about how they might be consuming these services. But in the first instance, just grappling for what they could get to keep or remain operational. We also saw increased requirements around connectivity and security. And security, I'm talking about at the network layer. So everything was being pushed over the internet. Then we saw lots of companies pull that back and start looking for cross connects or private line connections into services they were doing. And a lot of those were coming through co-location. Increased requirements for remote services. We weren't able to get, weren't able to get into the office, so we had to build up our own IT presence in many countries. In some countries, I worked for a company previously where we had a workforce, I think it was in the Philippines, and they had particular regulations around even enabling work from home or allowing work from home, which had to change, and they had to get staff geared up with access and remote services. So we saw a huge demand for those remote services and peering and other things. And then investment. So, you know, I've never fielded so many calls from investors in my life since COVID. Data centers, all of a sudden, that were already starting to look like a great asset class, it started to look like an even better asset class, even to those not very familiar with the sector. We saw more money come in, whether it be to acquire land, to sell on to data center providers, or whether it be to fund data center providers, or even form new companies or buy portfolios. But it wasn't all a brilliant story. So at the same time as dealing with increasing demand across some areas, providers also had to look at deal with restrictions on provider and customer access. Not so much a problem for existing customers. Existing customers did see restrictions on entering sites, but new customers. And it was quite difficult for some providers to sign deals when they couldn't actually get customers on site in the first place to see those sites. There was also restrictions on build activity and contractor access. And now that could be everything from complete lockdown, stopping construction teams, to actually having, you know, not being able to find enough portaloos to actually be able to enable safe going back to work and under COVID conditions. We heard many different cases. Planning restrictions. So this happened in a number of ways as well. In some markets, we heard that got the number of government staff on hand to actually issue planning permissions for companies had reduced, but on other hands, we heard that, you know, restrictions to site access caused delays, or, you know, there were huge backups of workload for some of those staff issuing planning permissions, and it could take a long time to get staff out to site. You might have another delay further down the road with one of your suppliers, and, you know, it all started to back up in many cases for some providers. We also had increased construction costs and increased timelines as a result of much of this. In some cases, construction teams had to be drastically minimized and construction timelines pushed out. There are also challenges with some supply chains, getting equipment to sites, etc. And these all compounded. So where we saw supply growth of close to 25%, 24% in the industry in 2019, we're now looking at a supply growth through 2020 of 14%. So it's quite a difference, and this is at a time when we've typically been seeing supply across these markets continually grow. Our take-up of 200 is also, you know, it's not too far off that, so there's still that high demand. And as a result, we're seeing these 5-year lows in vacancy in some markets, 13% for Frankfurt and 11% for Paris. I was talking to somebody familiar with the commercial real estate market, and they said that they thought that that was particularly high and they couldn't quite understand it, but trust me, these are particularly low rates for the data center industry when actually being able to provide a supply pipeline and ability for your customers to grow is quite important. So this hasn't actually been a story of lessening demand, and I think, you know, that 184 that we're looking at for take-up of this year would probably be bigger if we had more supply coming online. In many cases, when we look at the hyperscalers, they're not going to take anything under 4 megawatts in many of these markets today. So if you've got constraints in supply and not enough single providers that can provide that in these markets, then you're going to see the market hold back or look for other options. So in 2019, 320 megawatts came onto the market. In 2020, we're expecting now 230 megawatts will be added. What happened? So some build projects that were scheduled for Q2 moved to Q3, Q4 and beyond. And in Q1, we started to see this happen as well. Q1, we had 5 facilities pushed to future quarters, and 4 of these were in continental Europe, where we first started to see COVID take hold. In Q2, we saw 12 projects shift to future quarters. 4 of those in Frankfurt and 6 in London, where we started to have our own lockdowns, and the others in Paris and Amsterdam. which are slower moving markets. Amsterdam was just coming out of its moratorium on build, so we didn't expect heaps of activity there anyway. And in Paris, we knew that providers had been seeking sites and you know, it was just catching up to its own demand anyway. But I think the most interesting ones were what we saw in London and Frankfurt. Lockdown also changed a lot of our customer conversations. So we started to see many more companies talk to us about consulting and blueprints and helping organizations that they're working with and customers look at how they're re-architecting their data center footprint and their own IT. The conversation was becoming more about business needs than purely the data center response to that. We also saw a reassessment of customer demands and definitely more investment in new technologies. And companies started looking at how they could maybe enable more remote operations of customer environments, for example, look at more automated ticketing and things like that. We also saw a reassessment of customer mix, and I think we'll continue to see this. There are going to be some organizations out there, we have to admit, that might struggle. Maybe not necessarily from the data center side just yet, but if we look at particular industries which aren't doing so well at the moment, and I think there'll be a lot of providers looking at how they might be able to diversify the mix of customers they have on the floor to overcome any future concerns. Uncertainty around build pipelines, that can be an awkward conversation with some customers, for some providers, depending who your customer might be. And in some markets, decreasing vacancy rates. Very similar kind of awkward conversations. So our predictions as we move forward. So our customer mix, we're still going to see the hyperscalers remain dominant, but growing requirements from the second tier cloud providers. Enterprises have held back a bit. They're going back, rethinking their environments. We think they're going to push forward with new models and use co-location more over time as they look to consume cloud and use co-location as that on-ramp. Connectivity providers and SMBs through the channel. So SMBs are also increasingly consuming online services, and you know, they will be going through partners in many ways to do that, maybe telcos, etc. And we will see, I think, colos become customers of other colos as they start to look at rolling out their own edge strategy. We'll also see the issues of people, power, and plots. So power is constrained in many of these markets. As we look to see supply shortages overcome, we will see more of a grab for power, but probably more of an investment in power as well. Land, we've definitely seen huge appetite for land acquisitions for data center builds across all of the European markets in recent times. But we've also seen increasing competition. The logistics sector is also looking for much of those land opportunities. Think about how much we're using Amazon, for example. As a result, we've seen land prices become higher. But we've also seen a lot more schemes come on the market as developers become aware that there's that demand out there. People have always been a challenge, another challenge for the industry, but you know, we are starting to hear that there is increasing competition from sectors like pharmaceutical for data center staff, and we've also seen, you know, we also expect, as we see some appetite for self-build hyperscale data centers, we'll see people become more the environment for people become more competitive. And construction, which we've mentioned, we'll see those challenges ongoing, and we'll definitely have a bit of a bottleneck for some of the construction projects. And investment. So we will see a lot more investment, a lot more funding come into the data center market, a lot more investment in land, more investment in power and efficiency as well. And the focus will be on, you know, from some companies even building additional sources of power on site, substations, it's different power generation sources as well. We will see a lot more M&A take place. There will be a grab to be able to get customers into new markets. There will be a grab to maybe attain retail co-location providers by wholesale providers to be able to enable more of a connectivity-led focus for customers as well. And we'll see developments around the edge and software-defined automation and AI technologies. I think we're already starting to see a lot of these kind of investments, and as we start to look at how we enable customers to provision their environments, become software defined themselves and consume co-location like cloud, we'll start to see companies look more at some of these investments. And thank you. With that, I will leave it open to questions.